higher margin areas like advertising and membership fees also contributed to the improvement in Q1 profitability. Our advertising business across markets increased 50%, including Vizio. Walmart Connect in the U.S., which doesn't include Vizio, grew 31%. Sam's Club U.S. ad business was up 21%, and we saw 20% growth in our international markets led by Flipkart. Membership fee income was up nearly 15% across the enterprise. In the U.S., Sam's Club continued to see steady growth in member counts, renewal rates, and increased penetration of Plus members, resulting in membership income growth of 9.6%, while Walmart Plus membership income grew double digits. Within international, membership income from Sam's Club China grew more than 40% as member counts continue to increase. SG&A expenses deleveraged 6 basis points, including the benefit from lapping last year's business reorganization cost. As expected, international and Sam's Club U.S. expense deleverage reflects planned investments in associate wages. Walmart U.S. deleverage reflected increased depreciation expense, as well as Vizio operating costs post-acquisition. As we previewed at our Investor Day, we experienced higher than expected casualty claims expense. We're accruing a higher rate for claims cost based on the industry trends that point to higher risk adjustment factors. We expect this trend to persist for at least a few quarters. Adjusted operating income was better than expected, with growth of 3% in constant currency, and adjusted EPS of 61 cents was higher than our guided range. Importantly, our inventory is at a healthy level, up 3.8%. That's obviously as important as ever as we head into a tariff-impacted period where cost pressures will impact item pricing and make it more challenging to anticipate demand by item. This is a highly fluid situation, and we'll need to manage quantity decisions as we measure the price elasticity of impacted items. I'm grateful that we have a team of experienced merchants, various levers we can pull, and the tools available to manage this in a thoughtful and proactive way. Our cash position provides the flexibility we need to lean into opportunities to grow share, while also continuing to invest in areas with long-term strategic value, such as supply chain automation, store growth, remodels, and tech. In April, we completed an approximately $4 billion debt issuance at attractive terms. We continue to expect FY26 CapEx to be in the range of 3 to 3.5% of sales. During Q1, we repurchased $4.6 billion in stock, an amount equivalent to our share repurchases for the entire year last year. We have a lot of confidence in our business and will continue to be opportunistic with buybacks if share price dislocations occur. Now, turning to guidance. As a matter of practice, we provide an update on our full-year outlook at the end of the second quarter, if appropriate. But I'd like to give some color on how we're thinking about the impact from tariffs. I want to start with reiterating our message from our Investor Day in early April. We have a lot of confidence in our strategy, and there is nothing about this current period that makes us feel differently about anything we've previously said about our long-term financial framework to grow annual sales about 4% and operating income faster than sales. We've seen during periods of economic uncertainty in the past, we tend to gain share and come out of the other side in an even stronger position. We expect this period to be no different. We'll play offense and may opportunistically invest in areas to improve our value proposition. But we're not fully immune from the financial impacts in the short term. We've done work internally to model various scenarios related to the ongoing trade policy discussions. These scenarios involve making assumptions about how long tariffs persist at certain levels versus coming down to some lower level once bilateral trade deals are completed. We also must make assumptions about the elasticity of demand as well as the overall macro backdrop in this environment. Perhaps it's obvious, but worth stating. The range of possible outcomes is much greater than when we originally provided our annual guidance. That said, in what we believe are the most likely scenarios that we've modeled, we still have the ability to achieve our full-year guidance for both sales and operating income. These scenarios involve the belief that trade policy discussions will result in bilateral agreements in principle, or the existence of good faith discussions moving toward agreements that could result in tariff levels lower than those initially proposed in early April. However, if we see a restoration of dramatically higher tariff levels, the impact on our financials could be significant and even jeopardize our ability to grow earnings year over year. In any case, we're comfortable with our ability to grow sales in the range we've guided for the year, though the mix of AUR versus units may be much different in these scenarios. While the swings from quarter to quarter could be large, we still think we can achieve our operating income guidance for the year, given what we know and our assumptions that I referenced. Should more progress on trade in the next several weeks be favorable, there could be upside. If elevated tariffs remain in place for an elongated period, there would be downside risk. We will know a lot more in a couple months, but we are equipped to manage this as well or better than other retailers. Turning to the second quarter, the operating environment is highly fluid, and it makes the very near term exceedingly difficult to forecast. The level and speed at which tariff-impacted prices could go up is more extreme than in normal periods. The U.S. is, by far, our number one market for sourcing. For the less than a third of what we sell in the U.S. that's imported, China, Mexico, Canada, Vietnam, and India are our largest markets. As Doug noted, we're encouraged by the recent trade negotiations, especially concerning China. The level of tariffs that result from those discussions, and the timing of when they ultimately become final, may cause larger swings in our financial performance from one quarter to the next. Moreover, there are two specific accounting methods that make these swings more difficult to forecast. I want to take the time to explain these because they may impact the second and future quarters given cost pressures caused by tariffs. The first relates to our method of accounting for the cost of inventory for the majority of our U.S. business, the retail inventory method, or RIM for short. We've always used RIM in Walmart U.S. It's not new for us, and it's a common method of accounting in the retail industry. RIM accounting applies a ratio of the actual cost of the inventory to its retail price to calculate ending inventory and therefore derive cost of goods sold. As prices go up, this can result in the potential for markups on our inventory and increased merchandise margin gains relative to periods of more constant price levels. To the extent that later markdowns need to be recorded, it can have an offsetting effect. The magnitude of these swings, both positive and negative, given the level of additional costs that could be applied to the inventory that we're purchasing right now, are unprecedented in our business and could result in swings in margin and earnings by quarter. The second is the possibility of LIFO-related charges as prices go up, which we experienced in Sam's Club US during a sustained inflationary period in FY24. We currently expect that sales growth on a constant currency basis will be in the range of 3.5% to 4.5% for the second quarter, though the composition of sales through AUR versus units may be different than what we expect today. Notably, if current exchange rates were to stay where they are right now for the entire second quarter, we would expect a headwind of approximately 120 basis points to reported sales growth. For operating income, the range of outcomes for the quarter is much wider. The information related to the trade discussions taking place is changing by the week and in some cases by the day. Importantly, we also want to provide flexibility for us to play offense in this environment. And lastly, our method of accounting for inventory could have a larger impact on our earnings than in normal quarters. For these reasons, the range of outcomes for the quarter is so wide that it would be impractical to provide a range of operating income guidance that investors could credibly rely upon. I want to encourage you to think about the next couple quarters in the aggregate. We may experience larger gains related to markups in the second quarter, and some of those may be offset by markdowns in the third and fourth quarters. It is why we've underscored the importance of managing inventory well in this environment. In total, though, we believe that we can still achieve our operating income guidance for the year. In closing, as we look ahead, while operating conditions are expected to remain dynamic, our strategy is clear. Our top-line momentum is strong, and we're flexing into our advantages to protect margins as we grow. History tells us that when we lean into these times of economic uncertainty, we emerge on the other side as a stronger company. We expect this time to be no different. We appreciate your interest in our company and are now ready to take your questions.
Thank you. At this time, we'll be conducting a question and answer session. If you'd like to ask a question today, please press star 1 from your telephone keypad, and a confirmation tone to indicate your line is in the question queue. You may press star 2 if you'd like to withdraw your question from the queue. For participants who are using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. So we may address questions for as many participants as possible. We ask you please limit yourself to one question. One moment please for our first question. First question today is from the line of Paul Lejuez with Citigroup. Please proceed with your question.
Hey, thank you, guys. Thanks for all the detail on your pricing philosophy tied to tariffs. Very helpful. My question is on e-com. Big milestone for the company, achieving profitability in the e-com business. Just curious what finally got you over the hump, and where to from here in terms of where margins in that business can go relative to the rest of the business, and what do you see as the key drivers of further improvement to e-com profitability from here? Thanks.
Paul, thank you for your question. This is John David. Let me start with just giving a little bit more detail on the global e-com profitability. We noted that we achieved it on an enterprise basis globally as well as for the U.S. segment. And so for you to break that down by segment, the U.S. was profitable, Sam's was profitable, and the international was slightly unprofitable. But if you take all of those together, we had a profit for the quarter, so we're really pleased with that. There are a few things that have driven the performance, notably in the U.S., and John will talk more about this, but one is the densification of our network. And what I mean by that is we have more customers that are coming to Walmart now and taking advantage of our e-commerce offerings. We're able to spread those deliveries over multiple households. So think about the opportunity to deliver a package to 5 houses on a street versus 1 house on a street. And so as we grow, we continue to spread those costs over more volume. The second is delivery cost. And this is where John and his team have made a tremendous amount of progress in reducing the unit cost. And this is a lot of the supply chain infrastructure that we've implemented. But part of that, too, is the willingness that customers have shown to be able to pay for expedited delivery. And what I mean by that is delivery within 1 hour or within 3 hours. We noted in the last quarter that fully a third of our customers are taking advantage of that option. And it shows the relevance of convenience. We've seen an uptick in that even in the most recent period. And so, John, maybe you want to add a little bit more, but to me, those are a couple things that stand out to help improve the profitability.
Yeah, thanks, John David. Paul, a few things. If you look back over the last few years, I think it's a combination of investments we made for about the last decade, and those investments would include getting our applications to a single app, building new fulfillment centers, enabling stores to be part of the Omni solution. The speed of delivery has been encouraging the last year. Our sub-3-hour deliveries are up about 91% year on year. John David mentioned also the scale of the operation. It has taken a number of years, but we're pleased with the progress and the growth. We've been running 21% growth for multiple quarters in a row. For customers in particular, what the team has done that I've been really impressed with is providing customers flexibility to serve customers when they want to be served, the way they want to be served. So a Walmart customer can shop at the counter, they can shop with curbside pickup. We have in-home delivery. Our first and third-party delivery options, including fulfillment services for our sellers, has been on a strong growth rate for the last few years. And that has resulted in, as John David said, lower delivery costs due to density and frequency. All of that put together has enabled us has helped us enable business mix with advertising, our data businesses. And when you put it all together, just really proud of the team to be able to sit here today and announce a quarter of profitability for the first time, as we told you just a month ago when we were together in Dallas. And importantly, the team has exited the quarter with momentum. There was a strong April. We had a strong Easter. Our Omni capabilities enabled us to deliver floral and other things that people need last minute for the Easter holiday and Mother's Day. So we'll keep working on better ways to serve customers, improving speed, improving density, and working efficiently across all the channels.
Thank you, guys. Good luck.
Our next question is coming from the line of Simeon Gutman with Morgan Stanley. Please proceed with your question.
Hey, good morning, everyone, and good quarter. So Doug and John David, you both touched on this. You built this business and financial model now that your margins could go up and invest faster for growth at the same time. I've asked you in the past about like the toggling that balance, and I kind of heard some of the prepared remarks on this. I'll push back and say, why not toggle it in favor of investments even more in this environment? We know how much, how important it is getting more gross profit dollars, especially in Gen Merch. Why not lean into there? And you said it yourselves, Walmart should be better positioned than most to navigate this environment. Thanks.
Yeah, thanks, Simeon. This is Doug. I'll go first, and then John David can comment. I think with our guidance where it is for the year, we positioned ourselves to be appropriately aggressive. I think as the quarters play out, we may make different choices depending on what's happening with pricing. It is fluid. We're watching what's happening with cost of goods. There are a lot of moving parts as it relates to merchandising these days. And as it relates to the retail prices, we'll watch where our price gaps are, but we'll also watch what customers are telling us and the response that we get from them and the pressure that they're feeling. So the bottom line is if we need to invest more, we can. Having said that, I really want to grow profit faster than sales. Like, we've been working on this for a long time. I think we deserve that. You guys deserve that. And if we can navigate this in a way as we balance all the interests between customers, shareholders, and everyone else, such that we can keep prices low enough to help people and grow profit faster than sales, that's what winning looks like to me.
I would underscore the points that Doug made. I feel, Simeon, that we are striking the right balance between investment and growing profits. If you look over the last 2 years, we grew operating income about 10% on average. Our guidance is, let's call it roughly half of that this year. And so this is a year of investment. But even while doing that, we are hopeful to be able to grow profits faster than sales. If there's, to me, a story about the quarter from a financial perspective, it's really one of the diversification of our income streams. And so you're seeing all these things play out. If you were to just take advertising and membership as an example, that's a quarter of our profits. Membership was really strong in the quarter. We grew each segment, membership, double digits. International was north of 20%. So you're seeing this diversification of our income streams that allows us to continue to take a very long-term perspective and invest in this business. So these are always a little tricky in terms of what striking that right balance, but we feel like the plan that we have right now is the right one for us.
Thanks. Good luck.
Our next question comes from the line of Christopher Horvers with J.P. Morgan. Please proceed with your question.
Thanks. Good morning, everybody. So I wanted to ask a question about the consumer and the upper and lower end. You called out strong gains with upper income households. Is that coming through on the e-commerce side mainly, in addition to what's going on in the store? And then on the other side, there's been a dialogue in the market that maybe the lower end consumer is getting weaker and seeing some incremental pressure and perhaps leading to some, bottom of funnel loss where they're trading out of Walmart to, lower sort of lower average cost locations and doing smaller shops. So can you talk about what you're seeing on both sides in terms of the health as well as the share performance? Thank you.
Christopher, it's John. I'll first anchor on comments that John David made early this morning, which are that customers, in some cases, we've heard of some concern. They remain choiceful and consistent. And we continue to see customers prioritizing value and speed of delivery. We have seen growth across all income cohorts in the quarter. Fortunately, and I'm proud of the fact that in April we saw a number of new customers, and it's probably a good time to remind you just the shape of the quarter in terms of the calendar. This is a calendar where we had leap year last year, and then we had a very late Easter. So February was softer than we expected. March was back to normal, and we exited the quarter with a very strong April, including a strong Easter holiday, which is a reminder that customers are prioritizing seasonal events, getting together, having meals at home, and importantly, we want to be very flexible for our customers. If customers choose to shop in store, we want to have a great store experience. We're very pleased with our remodel program. We continue to see accelerated results and high NPS scores after remodel. Our fast delivery scores are some of the highest scores that we have in the company. And over the course of the rest of the year, you will continue to see us expand our capacity and capability to deliver from FCs quickly, including same day, next day, and 2 days. And we are growing our fast delivery options almost 100% year on year. You heard that this morning, growing 91%. So we'll continue to focus on value with great products in meat, produce, our Better Goods line. Really proud of the progress in apparel. Toys has had a strong quarter, particularly the holiday. And then we'll remain very, very flexible for our customers as we move throughout the year.
I think from a Sam's Club point of view, I underline everything that John just said. I think that right now, I think we're leaning into the power of the model of the membership a warehouse retail model. We have incredible prices because we've curated items for members. And what we find is that this resonates whether you're, earning a lot of money or whether you're working through how you spend your money each toward the end of your pay packet. We're seeing growth in convenience. We really see that convenience is something that resonates for everybody. And in fact, what we give them back is the power of time. So if we make things easier for people, they have more time, and that's incredibly valuable to people. So I would just close by saying that the growth in our membership, the 5%, 10% growth in our membership income is driven by more people renewing, more new members, and a higher mix of plus participation. And we're seeing that across all of our income cohorts.
Our next question is from the line of Peter Benedict with Baird. Please proceed with your question.
Hey, good morning, guys. Thanks for taking the question. So mine's kind of on capital allocation. You talked about CapEx, 3 to 3.5% of sales. Sounds like that probably trends towards the upper end of that range this year. I'm wondering if you could frame where we stand with the automation investment and the spend on that. On that front, should we be thinking CapEx in dollars is kind of at a peakish level here, at least for the intermediate term? And then on the buyback, great to see in the first quarter, it looks like you spent, as you said, more than last year, but also more than 2 years ago. Any way we should be thinking about that going forward and your willingness to commit more to buyback? Thanks so much.
Sure, Peter. Thank you for the question. On capital allocation, I'll start with CapEx. The right way to think about that level for our business is in the 3 to 3.5% of sales. So that should grow with revenue as we go forward. It may vacillate a little bit between the top end and the bottom end of that, but given what we know and the opportunities that we have to drive improved returns through some of this investment, we're not shying away from this. And we're taking a very long-term perspective, even in this current operating environment where we see some of those costs are coming in higher. We look at capital allocation as every dollar has to fight for its highest return. And this is one of the best ways that we can spend a dollar. That said, we saw significant price dislocation in the quarter as some of the uncertainties filtered through the market. And we were very aggressive in our share buyback, as I noted, buying back more than we did in the entirety of last year. And we'll continue to do that as we see price dislocation because we have a lot of conviction in our strategy. We have a lot of confidence in the plan that we have, and we believe there's a lot of shareholder value to be created here. And so as we see these types of dislocations, you're going to see us be more aggressive. I think it's fair to say, obviously, we're going to spend more in share buyback this year than we did last year, given that we've already done that 1 quarter into the year. The total amount of that, is to be determined. We'll see where prices are. We need to balance this with both increasing our dividend as well as investing in ourselves through CapEx.
Our next question is from the line of Brad Thomas, KeyBanc Capital Markets. Please proceed with your question.
Thanks. Good morning. The Walmart Connect growth was particularly impressive this quarter and showed some acceleration for you. I was wondering if you could comment a bit more on the strength in advertising and any incremental learnings you've had so far as you continue to integrate Vizio. Thanks.
Hey, Brad, it's John. We had a good quarter with Walmart Connect, as you mentioned, up 31% year on year, and also a strong quarter around the world in the other advertising businesses that we operate. We're in the initial stages of integrating Vizio. I'm excited about the plans we have for Vizio the rest of the year. It's a great operating system, very frictionless, easy to sign up, and we're looking forward to the contributions of the Vizio team going forward. In terms of the core advertising business, we've had strength with the growth of advertising with our marketplace sellers. Our GMV and marketplace has been very consistent in the mid to high 20s. Last quarter was in the mid 20s as well. We also have had continued strength with first party and third party suppliers. So it's a broad mix of capabilities. Additionally, this quarter, we launched pharmacy delivery. And that's another opportunity for our customers to enjoy the flexibility that we offer. And so there will be new opportunities, I think, as we go forward and look ahead. But in general, we're really pleased with the progress, the momentum, and the team that we've established in Walmart Connect.
Our next question is from the line of Michael Lasser with UBS. Please proceed with your question.
Good morning. Thank you so much for taking my question. John David, in your remarks, you said if elevated tariffs remain in place for an elongated period, there would be downside risk. Now, you guys are astute poker players and probably will not clearly define what elevated tariff rates are, but would you consider the current level of tariffs to be elevated, meaning that there could be downside risk if they don't come down? And more importantly, over the long term, is there anything about this tariff situation that would existentially impact Walmart's margins? Meaning that given the opportunity of time and flexibility, you would be able to fully mitigate all that you see in front of you, and or such that you would be able to have margin rates that are consistent with what you would expect to do over the longer term. Thank you very much.
Thanks for the question, Michael. Let me start with the second part of your question first. We don't see anything, and we indicated this in our prepared remarks. We don't see anything that changes the way that we think about our business long term related to the current environment that we're in. And so we think that we can navigate this. I think the thing that everyone is focused on, certainly the Fed, is to make sure that these are a one-time price increase and not something that persists and bleeds into wage growth and other things that have a more longer-term effect. In terms of the first part of your question, what I was referring to is were the level of tariffs that were announced at the beginning of April. Keep in mind, a week ago, we were at 145% tariffs in China. And certainly, as well as anyone, the preparation that goes into this day for us. And so when we started the preparation around earnings, that's the construct that we were working under. And 145 tariff environment and tariffs at a level that are, approaching 50% for other countries is not a good outcome for retailers. It's not a good outcome for the economy. We're very pleased and appreciative of the progress that's been made by the administration to bring tariffs down to this level. And the guidance that we gave today, the affirmation of our full year guidance, is with tariffs at this level. But let me emphasize, we still think that's too high. There are certain items, certain categories of merchandise that we're dependent upon to import from other countries. And prices of those things are likely going to go up, and that's not good for consumers.
The next question is from the line of Edward Kelly with Wells Fargo. Please proceed with your question.
Hi, good morning, everyone. I wanted to follow up on another tariff question and inventory planning. And as you stated, it's a difficult backdrop for planning inventory. Tariffs, obviously a moving target, I think uncertainty around elasticities. So against that backdrop, how are you thinking about the planning of the inventory? Do you stay lean, hoping that tariffs come down? Do you get aggressive because we're on a 90-day pause? And bigger picture question that I have related to this is, can you avoid the risk of another 22 scenario? Given the dynamic backdrop, do you think that that's a risk for retail? Thank you.
Yeah, thanks for the question, Edward. This is Doug, and you guys can chime in if you want to. I think the way to start is to remind you, as I said in my prepared remarks, that we have a lot of replenishable items at Walmart. It's such a strength to be operating off the side counters rather than some sort of high-low marketing-driven model where we're focused on features in the Action Alley and the end caps, for example. So on replenishable goods, we have the opportunity to partner with our suppliers to see what happens with sales as costs and then eventually retails adjust, and then manage that through the weeks and months ahead. So that's a great position to be in, and our merchants and our replenishment team are really good at that, and they're managing that on a daily basis. As tariff numbers have changed, they've done a great job of pivoting, recalculating quantities, and thinking through it again. Where it can get more challenging is we make decisions related to things like Halloween and Christmas farther out. And how do you make a quantity call, and what tariff number do you use? And the best answer we can give you is we've got a sales plan. We're operating against that sales plan. Some of the quantities will be adjusted based on what we think the tariffs are going to be. We've made some tariff assumptions, and then we'll partner with our suppliers to flow that. And if we need to chase goods, chase some goods. And the bottom line is, we want to avoid what happened back in 2022. And by paying close attention to our unit decisions, that's how we'll do it.
Our next question comes from the line of Kate McShane with Goldman Sachs. Please proceed with your question.
Hi, good morning. Thanks for taking our question. We wondered if you could talk about how the tariff situation is impacting your sellers on Marketplace, both from an inventory standpoint and how you think about the contribution to advertising as a result of this more difficult environment.
Hi, Kate, it's John. In terms of overall inventory management, Walmart, along with our capability to serve sellers, we've built a number of tools in the last 3 years that are particularly helpful. And for sellers in particular, having services like Walmart Fulfillment Service with heightened visibility of their inventory, where it is, our ability to move around the country is particularly helpful. As we sit here today, the ports are flowing, inventory is moving, so we don't have any concerns at this point about port backups in the United States, so our inventory is flowing through. I did mention earlier that our GMV growth rates in Marketplace in particular have been consistent over the last few quarters. You saw that in the release. We're also seeing that again as you exit the quarter. So we had a strong April in e-commerce, and this is a big contributor to the overall health of the e-commerce business with the 21 growth rate that has been in place for some time, which we are pleased to see. And then finally, adding together our stores, our first-party e-commerce business, our new automated fulfillment centers, distribution capabilities, our third-party business and fulfillment services, that has enabled us to have this ad business and data business, which has helped us mix out to achieve our first quarter of profitability in the United States.
The next question is from the line of Scot Ciccarelli with Truist Securities. Please proceed with your question.
Good morning, everyone. I know you talked about 50% growth in advertising and 15% in membership. So can you help reconcile those figures against what looks like just under 4% growth in the membership and other line in the P&L, just so we can better understand the components there? And then secondly, now that e-com has turned positive, can you provide any color on the magnitude of losses you had incurred over the last, call it, year or two, just so we can better understand the size of the profit improvement? Thanks.
Sure, I'll take the question. First on advertising, really pleased with the growth that we've seen there. It was inflated this period because we've got Vizio in there versus comparing it against a period that we don't. But our overall advertising on an apples-to-apples basis was 27%, so we feel really good about that. On membership, we felt really good about the progress there. As I noted, we had international that grew north of 20%. Both Sam's and U.S. grew double digits. The line that we have in our P&L includes other. It says membership and other, and that includes things like sustainability income. So think about recycling revenue, things like that. And that's probably a larger figure than what some people expect. And so that's the reconciliation to, I think, the 4% number that you quoted there. But overall membership is actually, it's really one of the shining points of the quarter. We're doing really well there. On e-com losses, I don't think I want to get into the magnitude of some of the losses that we've had historically. We've consistently, though, for years seen improvements there. You'd have to go back several years to see the depth of sort of where losses topped out. But John and his team, and it's really all segments. So if you look at what Flipkart's doing in India, look at what Sam's has been doing, we've continued to see contribution profit be positive. And with the digital platform, as you grow that at a positive contribution profit, you ultimately get to overall profitability, which is where we are today. So, this is kind of a milestone moment for us as a company. Hopefully we don't talk about it every single quarter, but I think it's notable this quarter that we've reached this milestone and we've achieved this level of profit, and we're looking forward to continuing to have that grow into the future.
The next question is from the line of Robbie Ohmes with Bank of America. Please proceed with your question.
Hey, good morning. Thanks for taking my question. I was wondering if you guys could give a little more detail on general merchandise. You guys had deflation in general merchandise in the first quarter. Can you help us think about deflation versus inflation and tariffs, for the outlook here for the next 3 quarters? And also, are there pretty significant differences between mix of general merchandise or changing in mix of general merchandise for in-store versus what you guys are doing in e-commerce?
Robbie, thanks for the question. I'll start, and some of the others may want to jump in. General merchandise has been deflationary for over a year right now, and we've seen the impact of that. And think of it as deflationary in low single digits in the quarter. Importantly, though, we grew units in the quarter, so we continue to see progress there. But the consumer is pressured. We've seen for a couple years now a shift in the baskets away from general merchandise to those items that are more necessities versus discretionary. So people are spending more on food. So we'll continue to monitor that going forward. But the team in particular has made really good progress on the assortment that we have, and really advancing general merchandise there. John, you want to?
Sure. Robbie, good morning. We did see strong growth in categories like toys, kids apparel, and our baby categories and others across the business. We do have stronger growth rates in e-commerce. In the total, you can see that as well with 21% growth rates, which would reflect really a strong mix across categories. And as we look at where we ended the quarter, we were softer in February. Just a reminder, we had really tough weather. It was lapping leap year. We had snow across the country, including the Southeast and on beaches across the Southeast. So we had unusual weather in February. Mentioned this earlier. March felt like more of a normalized month, closer to what we expected given the flip in leap year and a much later Easter. And then as we got to Easter holiday, the units strengthened pretty significantly. And we reported this morning that we were slightly negative in general merchandise with deflation. But was really encouraged by the results that we had from the Easter holiday until the end of the quarter.
Yeah, and in Sam's Club, we hit our fourth positive quarter of GM sales back to back in a deflated environment. So units are the driver of that performance.
Our next question comes from the line of Rupesh Parikh with Oppenheimer. Please proceed with your question.
Good morning, and thanks for taking my question. So I just want to go back to the strong momentum in the health and wellness category.